This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 3 videos on trading in the middle and the end of the day. Most days, the market has at least 2 types of price action. For example, a trend and then a trading range, or a trading range and then a trend, or a trend in one direction and then a reversal into an opposite trend. Traders like to trade at the beginning of the session because that's the highest probability of getting a swing trade. In the stock market, traders also like to trade at the end of the session. That's not the case in the Forex sessions because usually the market becomes very quiet at the end of the session. When trading stocks, traders trade the beginning and they trade the end of the day, and then whatever is in the middle, they trade whatever is there. So they think of the day of having 3 parts. A beginning part that they like to trade, an end part that they like to trade, and then the middle could be anything, and a lot of times they'll trade it much less aggressively. When you're trading in the Forex markets, the beginning of the session is very important, and then a transition becomes important. That would be typically the middle of the session, and the end of the session is much less important because the market usually enters a tight trading range and there's very little to do. From the market cycle, everybody knows that the market can only do 3 things. It can go up, a bull trend, it can go down, a bear trend, or it can go sideways, a trading range. Most days change behavior after 1, 2, or 3 hours. Therefore, traders have to be ready for a change because if the market behavior changes, the traders have to change how they're trading. For example, here we have a bull trend on the open, but then we have a parabolic wedge top, and we ended up getting a bear trend for the remainder of the session. We have a strong sell-off on the open, and the market is trying to reverse into a bull trend. However, it got a lower high, a new low, and then it formed a series of lower highs and lower lows. It was a broad bear channel. There was a tight trading range in the middle when the market was deciding whether it was going to reverse up into a bull trend or resume down in a broad bear channel with lower highs and lower lows. The market began the session with the trading range and then broke out and had a strong bull trend. The market opened the session with the trading range, and within the trading range, there's always a bull trend and there's always a bear trend. This could have continued up in a bull trend. This could have been a successful higher low major trend reversal into a bull trend. This could have been the start of a bear trend, and in fact it was. A trading range and then a breakout, and then we also had a reversal. Opening trading range, traders expecting a breakout, but sometimes an opening trading range can last the entire session. In this particular case, it lasted most of the session and broke out at the end. It tried to break out above the top, it failed, it then reversed and broke out at the bottom. You trade it like a trading range in here. Maybe you start trading it like a trend here, or you wait for a strong breakout, which we did not get. And then once it starts to break strongly to the downside, you trade it like a trend. Strong trend on the open. First reversal up, probably minor, which means first reversal up either will transform the strong trend into a trading range, or it'll be a bear flag leading to a second leg down. Here it led to a small second leg down, and then a lower low major trend reversal, and then we have a reversal. If you look at the daily chart of Forex markets, most days have prominent tails on the top or on the bottom, and that is caused by a reversal. And therefore, traders should be looking for some kind of a reversal on most days. For example, the market went up and it went down. This would create a tail on the top of the bar on the daily chart. Here, the market went down and then it went up. And the same with this. It went down to a new low of the day, and then it reversed up. That creates a tail on the bottom of the chart, on the daily chart. Strong sell-off, trading range. Traders expect either trend resumption down or trend reversal up. Most days when you're trading the Forex market, there is no final third. In other words, there's no end to the middle of the day. When the middle of the day ends, most days end quietly in a tight trading range. You only think about the end of the middle third if the market's changing to another type of market behavior. Bulls tried for a late rally, but it became a small wedge bear flag. Any reversal when a channel is this tight is probably going to be minor, which means it'll be a bull leg in a trading range or a bear flag. So this is not likely to change its behavior going into the end of the day. The market sold off strongly, and the bulls tried to get a reversal up, but one bar bad follow through and became a lower high in a broad bear channel. Therefore, the middle third, when it ended, really only ended briefly, and the broad bear channel continued for the remainder of the day. First 2/3 of the session was a trading range, and then we had a strong breakout. This is unusual. Usually, the end of the session ends with the market going sideways. So if the market continued sideways for the first 2/3 of the session, it's probably going to be sideways for the end. Sometimes there's a news event that can occur at any time during the day. Here, it occurred at the end of the session, and it led to a trend at the end of the session. That is unusual. It's especially unusual if you're trading the US session, which typically enters a tight trading range for several hours before the Asian session begins. This is a fairly common situation. The market trends down, not all that strong, lots of overlap, lots of minor reversals, and then it gets a reversal up into a trend at the end of the session or in the middle of the session. Traders need to be looking for a reversal when they see a trend that does not look particularly strong. First 2/3 was a trading range, and it's starting to transition into a very tight trading range, and then some news event happened. It does not matter what the news is. All that matters is the market starting to accelerate to the downside, and it's probably going to go lower. You change how you're trading when you see a change in the price action. A strong sell-off and then trading range. Market's in breakout mode, but there's not much time left to the session. Here, it had a brief breakout for a couple of bars. Very difficult to make much money when the breakout only lasts a couple of bars. Strong trends up occur a couple times a month. Strong trends down occur a couple times a month. By a strong trend, I mean a trend that just trades relentlessly in one direction. Here up, here down. And the pullbacks are small. This is a small pullback bull trend. Here the pullbacks are small pullback bear trend. Very often they start looking like they may be legs in a trading range. They start weak and then they become stronger. Here, starting weak looks like a leg in a trading range, and then it became stronger. Traders decided that it was going to be a strong bear trend day. It was not climactic. There were not a series of big bear bars followed by big reversals. It sold off in a very orderly fashion. Small bars relentlessly going down, pullbacks only lasting 1, 2, or 3 bars and not going up very far. Traders are selling for any reason all day long. If you looked at a higher time frame chart, for example, this is a 5-minute chart. If you looked at a 15-minute or a 30-minute chart, it would be a series of bear bars closing on their lows with no pullbacks. This is a very strong bear trend. Most of the time, even if you have a strong trend on the open, even if the strong trend lasts several hours, the market's going to transition into some other type of trading. Here, there was a trading range after a very big trend lasting a lot of hours. Here, the market started to transition into a trading range, but got higher lows, higher highs, and ended up in a relatively flat channel for the remainder of the day. This type of day where it stays in a very small pullback bull trend, you get a couple of them a month, you get a couple of these a month. This is more likely where it starts to look like a strong trend and then has a reversal. Most days, if you look at the daily chart, have a tail on the top and a tail on the bottom. Those tails are caused by reversals. We have a trading range and we're breaking out into what appears to be a strong trend. This looks like this. However, we got a reversal. Big bull bar, bigger bull bar. The biggest pair of bull bars, 20 or more bars into the session. More likely climactic, which means the trend ends. A biclimax does not usually lead to a reversal. It sometimes does. Here it did. Usually it leads to an end of the climax for 5 or 10 bars, and then the market decides whether to resume up or to reverse down. This is a very tight channel with 3 or more pushes up. 1, 2, 3. It's a parabolic wedge. It's breaking above a very tight bear channel, and the breakout failed. What's important here is this is different from this and this and this. Do you see the difference? We're getting a lot of bear bars, and we're pulling back for a lot of bars. We're pulling back for about 6 bars. This increases the chances that instead of simply a small pullback bull trend, this could be the end of the bull trend and possibly even the start of a reversal. Here is where the bulls gave up and the market decided that it was now in a bear trend. Parabolic wedge, 3 pushes up. 1, 2, 3, trying to get a bull breakout above a tight bull channel. Typically fails. Every trend bar, every series of trend bars is a climax, a sell climax, an even bigger sell climax, another big sell climax. When you start to get big consecutive sell climaxes, the sell-off usually is unsustainable, and it's usually going to transition into a trading range, which it did here. Once it's in a trading range, it then can form a major reversal. Here, a higher or low major trend reversal, and the bulls got a breakout toward the end of the session. The first reversal up is usually minor, and if it's a strong first reversal up, when the trend resumes, traders will look for a major reversal on the next reversal up, which they got here. Early in the session, we have a very big bear bar, another big bear bar, several big bear bars. But the follow-through is bad. Big bear bars followed by big bull bars. This is probably not the start of a big bear trend. If you're going to have a big bear trend, typically you do not have big bull bars early in the day. Likewise, if you have several big bear bars early in the session, you're probably not going to have a big bull trend. And if you rally, it's probably going to be more of a bull leg and a trading range. Big bull bars, bad follow-through. Bull bar, doji, bull bar, bear doji. Bull bar, small bar, bull bar, doji, bear bar, big bull bar, bear bar. This looks like a bull leg and what will end up as a trading range. This looks like a bear leg and what will end up as a trading range. Here, we get a reversal up, bear leg and a trading range day, bull leg and a trading range day. This does not look like the start of a strong bear trend day. This does not look like the start of a strong bull trend day. This is a reversal. It went down and went up. Although it rallied for several hours and got to a new high, it did not get far above the high. And that's the case with most reversals. I think of a reversal as a trading range. It trended down, it trended up. Yes, it was a bear trend. Yes, it was a bull trend. However, it ended up around where it started, and I think of a reversal day as a trading range day. If you do get a strong sell-off lasting a lot of bars, and then you get a reversal, usually the market has a hard time getting much above the open. If the initial sell-off is not very big and you get a reversal, you can get a very big trend. For example, here we sold off on the open and we get a reversal and you ended up with a very big trend. If the initial sell-off covers a lot of pips and a lot of bars and then you get a reversal, usually, even if it rallies for several hours, it's not going to get far above where the bear trend began. Here's another example. Strong sell-off and reversal. It did not get far above the beginning of the bear trend. So yes, it was a bear trend. Yes, it was a bull trend, but it ended up right around where it started. Trading range day has at least one leg up and one leg down. Either one can come first. Here we got down and then up, but it ended up closing around the open. Whenever there are problems with the initial trend, traders need to be prepared for the trend transitioning into a trading range or into a reversal. This began as a small pullback bear trend day. We got a series of bull bars here. None of the bars is all that big. Pretty good pullback here. Possible leg one pullback, leg two. It looks like it could do this. However, once you start to get this, you got to think something's wrong with the bear trend. Minor reversal, yes, but a strong minor reversal and a weak trend. And you know most days have some kind of a reversal. This could be the start of that reversal. Most sessions begin with a trend of some kind early in the first hour or two, and then they transition into a trading range. Once the market is sideways for 20 bars or so, you have a trend resumption, trend reversal setup. So trend, trading range, bulls want a second leg up, trend resumption, bears want trend reversal down. The more bars they get added to the range, the more the probability is 50-50. Initially, this is a bull flag. We have a bull trend and a bull flag. But once it grows to 20 or more bars, the probability starts to get closer and closer to 50-50 that we'll get a reversal instead of trend resumption up. They look pretty much the same, these two sessions. Early trend, trading range, trading range. 50-50 chance of trend resumption up, 50-50 chance trend reversal down. Here's the bear case. Market traded down for a couple hours and then a bear flag initially, still a bear flag, minor reversal, but it became a trading range. Very similar case here. Strong bear trend and then minor reversal up, and instead of a bear flag, it became a trading range. Once you get 20 or more bars in a trading range after a trend, the market's in breakout mode. That means the probability is very close to 50-50 that you'll get a bull trend or a bear trend for the breakout. In general, if I see a trading range, I always look to the left. Here, a bull trend, I think the probability is always slightly higher that the trend will resume, but it's very close to 50-50. It's not 60%. It's more like 52, 53%, especially after the trading range lasts 30, 40 bars. Then it's essentially 50-50. Here, we got trend resumption up, breakout, follow through, another breakout, and the final third of the session became a bull trend. And the entire day was a bull trend day that went sideways in the middle. Here, bull flag, and then it pulled back for a lot of bars. It became an endless pullback, probably a trading range, but then the bulls gave up and the bears got a breakout. A decent-sized bear bar, a series of bear bars, probably going to fall for at least a measured move down based upon the height of the range. The bears tried to get trend resumption down, but did not get very far, and the market remained mostly sideways for the remainder of the day, starting here. It was sideways to a little bit down. The bulls got a higher low major trend reversal, breakout, follow through, and a little bit more up at the end of the day. trend resumption down, trend reversal up. I talked about the importance of looking for a transition. A strong bull trend day that trades up for the entire session or the entire day occurs only a couple times a month, and a strong bear trend day occurs only a couple times a month as well. Most days have some kind of transition and at least two types of price action. If you see a bull trend early, you have to expect a transition into a trading range or a reversal into a bear trend. If you see a bear trend early, you have to expect a trading range or a transition into a bull trend. You have to be prepared to change how you're trading. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 3 videos on trading in the middle and at the end of the day.